In 2007, one of the most arrogant assumptions in the history of finance was put to the test. A group of elite hedge fund managers, utilizing the most complex algorithms money could buy, claimed they could beat the market. They were so confident that they accepted a $1 million bet against Warren Buffett. The terms were beautifully simple. Over 10 years, could these hedge funds, charging premium fees, outperform a boring, low-cost S&P 500 index fund? Buffett, the architect of wealth, took the bet. And today, we aren't just going to look at who won. We are going to look at the mathematical reason why complexity almost always loses to a simple, perpetual system. If you want to build true wealth, you need to understand the graph of your own failure. To truly grasp the magnitude of this bet, you have to understand the friction of finance. In our previous discussions, we established that compounding is the engine of wealth. But friction? Friction is the exact enemy that slows that beautiful engine down. You see, these elite hedge funds operated on the classic 2 and 20 model. That means a 2% management fee on your total capital plus 20% of your profits. On paper, this sounds like a brilliant incentive to win. In reality, it is a mathematical headwind. Even before the market opens, even before a single trade is made, you are starting the race with a deficit. Imagine two runners on a track. One is wearing standard gym shorts. The other, the hedge fund investor, is running in a full, heavy suit of medieval armor. The runner in the armor has to exert massive energy just to stay even. Over a decade, that 2% friction doesn't just add up. It compounds into a massive gap in your net worth. Warren Buffett made a $1 million bet. We built this Python simulation using real market data to visualize exactly what happened. The blue line is the S&P 500. The red line represents elite hedge funds. Almost immediately, the 2008 financial crisis hits. Blue is in free fall, while red manages to cushion the blow. Were the highly paid fund managers right? Is capital protection everything? But wait. As the market begins its recovery, the dynamic shifts. The blue line isn't trying to be smart. It's just surviving and expanding with the global economy. The red line, meanwhile, is suffocating, desperately trying to catch up while dragging the heavy anchor of massive management fees. After 10 years, the so-called smart money is completely crushed by the relentless compounding power of a simple index fund. And whenever the market dips, the hedge fund's fees act like a heavy anchor, dragging the portfolio down deeper than the average. The managers were not just trading stocks, they were trading against the math of their own fees. The tragedy here isn't that a few billionaires lost a bet. The tragedy is that millions of everyday investors pay for this complexity every single day, completely convinced that active management is safer. But as the data unequivocally proves, you are paying a premium to underperform. You are paying for the illusion of control. So, what does this mean for you? Are you playing a game of luck? Or are you building a perpetual engine? Wealth creation is not about how much action you take. It is about how much friction you remove. By choosing low-cost, systematic investing, you are removing the middleman who steals your compound returns. You are letting the structural expansion of the global economy do the heavy lifting for you. When you see the next big strategy promising massive returns, remember the 2007 bet. Remember the math. Complexity is not a strategy. It is a tax on your future. Perpetual Investor doesn't chase the noise, but builds the engine. If you are ready to stop gambling and start building, hit the subscribe button. Don't hype. Focus on long-term strategy and compound growth. Start by mastering the mechanics of wealth. See you in the next analysis.